Hey there, and welcome to This Explainer. If you deal with business finances in Saudi Arabia, you already know that navigating the tax landscape can honestly feel like walking through a maze. But today, we're bringing absolute clarity to one of the most critical areas of Saudi corporate finance, the complete ZATCA tax depreciation system. We're going to break down the rules step by step so you can seamlessly move from your standard accounting profit right to your final taxable income. Let's dive right in. Okay, so before we even touch a calculator, there is a massive mindset shift you have to make right off the bat. The quote says it all. When you study Saudi income tax depreciation, do not think like an accountant first. Think like ZATCA. See, the absolute biggest mistake professionals make is trying to force standard international financial reporting standards, or IFRS, onto their tax returns. It just doesn't work. ZATCA, the Saudi tax authority, has its own system, its own rates, and its own totally unique logic. Unlearning your accounting reflexes is literally the secret to calculating your tax bill correctly. Here is our roadmap for today. First up, think like ZATCA. Second, the 5 buckets. Third, the 50% rule. Fourth, selling and recapture. And finally, number 5, the big picture. Let's start with section 1. Think like ZATCA. To really succeed here, you have to accept that your financial statement profit, that's just the starting line. It is absolutely not the finish line. We're basically talking about maintaining 2 completely separate parallel universes. Over on the left, your standard accounting schedule tracks every single asset one by one, usually on a straight line basis over its useful life. But on the right, your tax schedule for ZATCA, it doesn't care about individual assets at all. It uses a pool method, dumping assets together, applying fixed statutory rates, and using a declining balance. You simply cannot use the left side to satisfy the authorities on the right. So, because those 2 universes are so radically different, the very first physical step you must take on your tax return is to completely cut ties with your accounting depreciation. Step 1, you look at your accounting profit. Step 2, you totally strip out the IFRS depreciation by adding it back to your profit. Why do we do this? Well, you originally subtracted it as an expense to get your accounting profit, right? By adding it back, you're essentially hitting reset. You reset your baseline to a before depreciation profit, clearing the stage entirely for ZATCA's rules. Moving right along to section 2, the 5 buckets. Okay, now that you've stripped out the accounting depreciation, you need a new place to put your assets, right? The core of this pooling system is how it completely simplifies your asset register. Instead of agonizing over tracking separate cars and computers, similar assets are just dumped together into one of 5 buckets, and each bucket leaks value at a fixed statutory rate. So machinery, equipment, software, and vehicles, they all get mixed together into bucket 3, depreciating at 25%. Slow-wearing things, like permanent buildings in bucket 1, leak at just 5%. The beauty here is you no longer track the individual items. You only track the total value sloshing around inside the bucket. Hold up, though. Before we go any further, I have to give you a massive warning. Land is never depreciated. Do not put it into any of these 5 buckets. Land doesn't wear out like a truck or a building does. If you buy a property for, say, 2 million riyals, you have to split that price tag. The building part goes into bucket 1 to be depreciated, sure, but the land part, that stays completely out of the system forever. Seriously, don't make the mistake of dropping land into a depreciation bucket. All right, let's hit section 3, the 50% rule. So we know about the buckets, but we need to understand the mechanics of actually pouring new assets into them. Half, 50%. That is the magic statutory number you have to memorize for the half-year convention. When you buy an asset, only 50% of its cost enters your tax bucket in year 1. The other 50%, it just waits around to enter in year 2. The absolutely crucial thing to understand here is that you never ever count months. This is not a date calculation. An asset purchased on January 1st and an asset purchased on December 31st get the exact same treatment. 50% this year, 50% next year. Let's actually walk through the math on this to see it in action. Let's say you buy a 100,000 SAR machine. It belongs in bucket 3, which depreciates at 25%. In year 1, applying our rule, only 50,000 enters the bucket. Your tax depreciation is 25% of that 50,000, which equals 12,500. Then in year 2, the remaining 50,000 finally enters the bucket, joining whatever balance was left over from year 1. From there, your bucket just continues to leak on a declining balance, meaning the depreciation amount gets smaller and smaller every single year. Which brings us to section 4, selling and recapture. Look, buying assets is the easy part. Selling them under ZATCA rules, that's where people really trip up. Selling an asset works completely differently than standard accounting. let's look at a normal sale first. Remember, we don't track individual assets. We track buckets. If your bucket 3 total is 200,000 and you sell a specific truck for 50,000, you do not calculate a gain or loss on that specific truck. You just reach into the bucket and pull out 50,000. The new bucket balance is simply 150,000. And because the bucket balance is still a positive number, your life is super easy. You just take your 25% depreciation on the remaining 150,000 as if nothing unusual happened. But what happens if a bucket actually drops below zero? This right here brings us to the system's biggest trap, recapture, which is also known as a balancing charge. Think about it for a second. You cannot own less than zero value of assets. If a bucket holding 20,000 rails of value is hit with a sale of 100,000 rails, you've essentially scooped 100,000 out of a bucket that only had 20,000 inside. That impossible extra amount isn't just some weird mathematical quirk, it is a direct clawback from the tax office. Let's run the numbers real quick. Your bucket has 20,000. You sell an old, heavily depreciated machine for 100,000. The math gives you a result of negative 80,000. So the crucial point here is, ZATCA says you recovered 80,000 more than the asset was worth for tax purposes. You must immediately set the bucket to zero, and that negative 80,000 becomes a real economic gain. It gets added straight back to your taxable profit, which directly increases your final tax bill. Now, here is where things get kind of wild. Remember that 50% rule we learned for purchases? Well, it also applies to sales. When you sell that machine for $100,000, you don't subtract the full $100,000 from the bucket in year one. You subtract $50,000 this year and the other $50,000 next year. This means your recapture, that painful add back to your taxes, might actually be split across 2 completely separate tax years. The total tax you pay stays exactly the same, but the timing of your cash flow shifts entirely. So, because we use a declining balance method, mathematically speaking, a bucket never truly hits zero. A tiny decimal fraction could theoretically linger in there forever. But ZATCA gives us 2 rules to permanently clear out these mathematical tails. Rule 17H is the small balance rule. If your year-end bucket balance drops below 1,000 reals, just write the whole thing off as a deduction. Then there's Rule 17I, the empty group rule. If you literally sell every single physical asset in a category, you are finally allowed to fully deduct whatever ghost value is left in the bucket, officially putting that math equation out of its misery. All right, let's pull back. Section 5, the big picture. Now we've got the mechanics completely nailed down, we really need to zoom out for a second. This next concept is absolutely paramount if you work with joint ventures. Saudi Arabia runs 2 parallel regimes. The income tax track applies to the foreign ownership share, utilizing the pool method, the buckets, and those recapture rules we just went over. The Zakat track, which is a religious wealth levy applying to Saudi or GCC ownership, often uses simple straight-line depreciation. If you're a 50-50 mixed company, you don't just blend this together. You must run 2 completely different depreciation tracks simultaneously on the exact same assets, carefully allocating the correct results to the correct tax base. Oh, and there's one final mechanical rule you definitely want to keep in your back pocket, the 4% repair rule. When you spend money maintaining your assets, you can only immediately deduct those repair costs up to 4% of the bucket's closing balance. What happens if you spend more? Any excess over that 4% is capitalized, meaning it just gets tossed right back into the bucket to be slowly depreciated over future years. Okay, let's pull all of this together. I've got this incredibly simple 6-word memory trick that will perfectly lock in everything you've just learned today. When you're faced with a tax depreciation problem, just follow this exact sequence. Books, add back, buckets, half roll, depreciate, deduct. Start with the accounting books, add back the IFRS depreciation, sort the assets into ZATCA buckets, apply the half roll for buys and sells, depreciate the new bucket balance, and finally deduct that tax amount from your taxable income. Boom! But before we wrap up, I want to leave you with one final provocative thought. Everything we've discussed today, that is current law. However, there is a draft income tax law floating around out there that actually proposes moving foreign taxpayers back to straight-line depreciation, aligning the 2 tracks. If that passes, it would fundamentally rewrite everything we just talked about. So, the real question is, how much longer will the ZATCA bucket system even survive? Until the shifting sands of Saudi tax laws settle, keep your buckets well maintained, keep your schedules separated, and never forget to think like ZATCA. Thanks for joining us on this explainer, and we'll see you next time.